Today I want to talk to you about tax planning, and specifically tax planning in retirement. Here at Straight Path, we view tax planning in retirement in 3 distinct stages. Each of these stages has their own priorities, their own goals, and their own specific strategies that we need to enact in each of these different periods of your life. And so the first period, the first stage of tax planning inside retirement is pre-65. So if you're planning on retiring before age 65, we need to do some special planning, and there's some different priorities for that time period. It's most important because until 65, you do not qualify for Medicare. So if you're retiring pre-Medicare age, pre-age 65, and you don't receive any employer health insurance or employer retiree health insurance anymore, we have to go to the individual marketplace. And that provides some opportunities and some also costs that we need to be aware of. And this is where tax planning in pre-65 in stage 1 of retirement becomes very important. If we can keep taxable income low, not necessarily cash flow, but taxable income low, we can qualify you for some subsidies and thereby keep your health insurance premiums lower than what they otherwise would have been without good tax planning. Stage 2 then progresses from age 65 up until age 72. And during that time period, we have the most flexibility. The IRS is not requiring us to do anything with any of your accounts. There's not as hard and fast cliffs and restrictions that we have to be aware of like there is pre-65 if we're trying to get some health insurance subsidies. Instead, we have a lot of flexibility. In this time period, we're mainly worried about keeping income below Medicare surcharge thresholds, making sure that we don't run into any hidden taxes. But those thresholds are much higher than what the thresholds are in stage 1, so we have a little bit of flexibility in stage 2. Then at age 63, we progress to stage 3. In stage 3, and the reason why age 73 starts this period of retirement income planning is because that's the age now with recent tax law changes that we have to start taking required minimum distributions, or RMDs. And RMDs are when the IRS requires you to take a certain amount of money out of your IRAs and 401ks each year. This has an impact because it forces recognition of taxable income each year. And so while we may not have a lot of planning opportunities left in stage 3, it's important to keep an eye on stage 3 even while you're going through stage 1 and stage 2. And so many times, a lot of tax preparers, a lot of CPAs, and even some financial planners will mainly concentrate on lowering your tax burden this year or maybe next year. But they really don't do the planning necessary to plan out what may be 1 stage or 2 stages later, and it might be 5, 10, 15 years down the road. And so making sure you balance the priorities and objectives in whatever stage you are now with the stages that you will experience later on in your retirement is really important. So again, we have 3 distinct stages of income tax planning in retirement: a pre-65 period, a 65 through age 72, and then a 73 and beyond. Each of those strategies, each of those periods have different priorities, different goals, and it's really important to make sure that your financial planner and your tax preparer are taking into account those different goals in each of those scenarios. If you don't feel like you're getting that done for you, it may be time to talk to a group of financial planners who concentrate a lot on tax planning and know what we're doing in this area. So if that's you and you're interested in talking more about what stage you're in and the different strategies, the different goals that would apply to you and could potentially cut your tax bill, please reach out to us here at Straight Path. This is an area of concentration for us that we've gotten really, really good at, and we'd love to help you save taxes, have more spending income in retirement, and live a more fulfilling life.